Good morning, everyone, and thank you for joining us for the latest edition of TAM Talks. Today's presentation poses the very relevant question of diversifying with alternatives, for which we have two presenters for you today. But before I introduce them, I'd like to go over some housekeeping rules for those who are unfamiliar with this setup. Below your screen, below the presentation, I should say, you will see various tabs. Now, you can find a copy of today's slides under the Attachments tab, which you can keep for your records. Votes will be live throughout the presentation under the Votes tab, which we'll be using to ask you what topics we should cover in future presentations. Questions can be sent over to be answered by our presenters in the dedicated Q&A session via the Questions tab, of course. And finally, you can rate today's webinar, which along with the votes really helps us tailor future presentations and make sure that they're relevant for you. Okay. So today, as I said, we have two presenters, first of whom is TAM founder and CEO Lester Petch, who has over 35 years investment experience working within major institutional houses, and he will provide a macro overview and outlook of sorts, followed by Investment Manager Stephanie Sotiriou, who is responsible for heading up the TAM ethical portfolios, who will be discussing how the team diversifies with alternatives in more detail. So without further ado, I will hand over to Lester for the first part of today's presentation.
Thank you very much. Good morning, ladies and gentlemen, and I'm very, very grateful that you spare the time to listen into our thoughts and ideas for the financial markets. I appreciate it's been a hot day out there and there's lots more you could be doing. Also, it makes it a slightly easier time to talk after a 4% rally overnight in markets, which sort of actually begs the question as to what we're going to talk about today. So very quickly, we're going to be talking about my own and the team's insight thoughts into what we think is going to happen next. And then Stephanie's going to review some of the alternative ways of looking at the markets and some of the things that we're looking at as well. So after the 4% rally, as I've just said, it does beg the question, are we actually in the eye of a storm? Well, having enjoyed this bull run for 9 years, markets fell 30% from those highs and staged a remarkable recovery, which is still ongoing. So why is it rallying? If you were to look at the numbers, you'd be quite horrified because in mid-March we really did sell off very hard and it was all coming to a crumbling end. Well, I, for one, I'm very much a US watcher because I'm afraid the UK can't stand on its own 2 feet. So whence the US goes, quite often whence the UK goes. So it would appear that investors have been buying into stocks under the assumption, in the case of the US, that the Feds will just keep pumping money into the markets and buying more and more assets and won't ever stop. So from the lows, we actually did get ourselves into a position where in mid-March, the unprecedented panic sell-off that affected everybody's, all instruments known to man except US government treasuries and gilts. The Fed stood its ground and committed huge amounts of capital to flailing markets. So what we've seen is when push came to shove, the Fed just stood up and protected financial markets. What it's initially done is drop its rates to 0%. It committed to buying $500 billion worth of government debt, $200 billion worth of mortgage bonds, and there's been limitless bond buying afterwards. And that would start to see protection in corporate debt markets, associated ETFs, high yield bonds. To this date, forgetting the money they've committed to the economic scenario in the US, they've actually spent $2.3 trillion supporting the markets. So my thing there is, really, please, one thing we shouldn't do is fight the Fed, because when they step in, there's really not much we can do about it. And what they did was increase huge stimulus packages were coming in. In various parts of the world, there were company support packages, or in individual countries, employee support packages. Infection rates were coming down. China began to emerge. And it was this whole scenario of they weren't going to let this thing go to waste at all. So investor confidence was restored and markets rebounded. Now, at the time, nobody thought that it was more than a transitory bounce, maybe a bear market bounce coming off the lows. But what we have seen is an ongoing commitment to the desire by the US Treasury and the US Fed to ensure that things stay stable. And so they stood their ground and they've committed capital to support failing markets. And of course, that's what made the thing rally. Now, the problem with this is it's now become a bit of a norm in the marketplace. I mean, I've been speaking to some of my friends in the financial markets, and they're beginning to call this the golden put. Basically, do what you want, the Fed will bail us out. Now, it's slightly over-exaggerative, but I wanted to make the point because I think it's very interesting that most of our senior investment managers, if you sat them in a room and put in a cool, dark room and said, what do you think is going to happen, they would be very, very negative or relatively negative about things. Not everybody, but that would be the predisposition of the room. Unfortunately, fortunately, that's not happening, because what's actually happening is the Fed standing up and it's standing there saying, you know, we are going to protect you. And who would have believed that, given the global lockdown, the huge spikes in unemployment, the complete closure of some of the economies, and company earnings are now not being even discussed in many quarters, and core companies are abandoning dividend payments, that we would find ourselves at a place in the markets that is really not even having given back our gains of 2019. In fact, I would say most investors should be up, some of them quite, fairly considerably. But if you look back to January 2019, you wouldn't have believed it. So this limitless financial government funding in the US for supporting real estate, mortgage-backed bonds, corporate bonds, and the government debt market makes the markets feel very sanguine about what they're saying. So I just wanted to put this up, which is probably quite small, but it's in your pack, because this is effectively what's happening with quantitative easing, which is the buying of all of these instruments that were under such severe pressure, basically. Their own government bond markets, their mortgage-backed bond markets, et cetera, et cetera. This has gone astronomical. So the cost to financial markets and economies, we haven't seen yet. And this is something that we've described in previous missives, and James Penny, our UK Chief Investment Officer, has described as a game of two halves, where the first half of this, we were very concerned with the deaths and the illnesses and the virus itself. And now we're getting into this sort of middle zone where we think we're all coming out of this, which I do hope we are, and that there is some safety going to return to our lives. And then we're going to enter this second phase, which is how are we going to pay for this? What does the economy look like? How is this going to phase out for us? How are we going to repay these debts? How's the government going to repay its debts? And I said the cost that we're actually building here is in this middle zone. And so it wasn't sort of too light that I said that we were in the middle of the eye of the storm, because at the moment there is a slightly sanguine approach to the commitment of the US Fed and others to support their financial systems. So the realization will eventually dawn that the long-term impact on the global financial markets, corporate earnings, unemployment, the need to refill tax coffers, there will be massive and mammoth debt issuance. There will be structural expenditure to rebuild, deflated economies. Ultimately, this is going to lead to the need for further commitment and further monetary policy. So what's going to happen now, I think, is that corporate soundness and an economic recovery is on the agenda. That wasn't there in March. It was a different game playing then, which was all about how we're going to survive this, how do we stop this illness, and how do we stop the spread of COVID-19. This glide path is not going to be easy for sure. We lost 10 years of economic growth and employment in 6 weeks. And the next 12 to 18 months will not be the same. So economic fundamentals, the need for re-employment, the speed with which markets revert to norm will depend on a core issue for me. And that is how much global governments are continuing to prepared to commit capital to paper over those cracks in the market that are going to materialise. Now, we've heard recently that straight from the US government that it's bottomless. Now, whether that's true or not, we'll only wait and see. But they're basically trying to keep markets calm, and they're doing it by actually spending money to do so. Collapsing growth, I just put up a chart there because we really need to understand that collapsing economic growth in the euro area at -7.5 for the year is just unprecedented. I actually personally think these are too light. I think it's going to get even worse than that because we are coming out of this on a very slow, methodical basis for good health reasons. But that's not really going to help the economy particularly, because what we're going to end up with is a staggered start to it. There'll be, I still feel that a lot of people, regrettably, that are going to come out of furlough, maybe won't have jobs. I'm not saying in our industry necessarily, but in many other sort of service industries. It's going to get extremely difficult and extremely bad. That sounds terrible. It's not that bad because, markets have been strong and there are winners. I mean, if you were in the NASDAQ in the United States, if you own shares in, these Facebook, Apple, Amazon, Google, these things are actually up. And it's not just these big, giant companies that are performing quite well. There are good spots in industry, in biotechnology, in healthcare, in the technology side of cyber technology, etc., that are doing it quite well. Anything that's doing remotely, you can obviously appreciate is going to be performing quite well. So it's not like the end is nigh here. This is what we're saying is that there are winners and losers even in these difficult operating environments. But what you do need to know is that what this is disguising is a very, very narrow market set. There are very few areas of these markets that are doing exceptionally well. I do reiterate, though, it is not all bad news. So what I wanted to get to is the question that everybody's going to ask me is what do you think, where do you think you're going to go next? What do we think is going to happen next? And I'm going to actually be quite bold and say that there is a battleground here. The battleground is cash and the Federal Reserve versus economic fundamentals. It's as simple as that. Economic fundamentals are shot to pieces in the short term, and without government support, bankruptcies are going to soar. Corporate America will not even forecast 12 months out for the most part. They just don't know what it's going to look like. Traditional analytical work is sort of in this period now is sort of fairly limited use. The successful investment call amongst the US manager fraternity is just buy what the Fed's buying, which sounds very naive and simple, but as long as that golden put is in place, things will stay, fairly sanguine, I think. So I started this by saying we're in the eye of a storm. And presently, to me, it feels like we're in a hurricane hunter that's just pushed through the eye wall, because we had a torrid time during the back end of February, March, and the beginning of April that felt we were in that hurricane. And we hit a bit more of a sanguine environment where people are getting a little more content with the way that their portfolios are moving, and they're feeling quite sanguine that, we're going to get through this, and so, and we will. However, the economic fundamentals that are going to hit us on the other side of this eye wall are going to be pretty heavy. And so this battleground of cash and the Fed versus economic fundamentals is the one that's going to test us and our thought processes over the next 3 to 6 months. Cash has never been so high in people's portfolios in the United States. There are very limited alternatives, and it's going to be about whether that cash and the Fed support, how much that's going to balance off against these horrific economic fundamentals that are going to be hitting us over the next 3 to 6 months. So, for me, there is a strong chance of a 15% sell-off. But as the economics unfold, and if this, what I've called a golden put, starts to dissipate, then that could go further because the economic fundamentals don't warrant it. But I'm very, very scared of this cash position from an investment point of view. I mean, I ran Japanese money during the super bull market, and it had no fundamentals behind it. It was supported by cash. So cash is a driver of equity markets as well. So what it leaves me with is we're about to hit the other side of the eye wall, which is the economic reality is going to hit us in the next quarter. And that will have a destabilizing effect and a sort of increase in volatility again. Hopefully not back to the March sort of environment, but it's going to be quite volatile, I think. And there is a new acronym that's in the United States, which leads on to what we really wanted to allude to today in the alternatives section, and that is TINA. It's a new word that they've coined in the United States for managing money in equity markets. TINA being there is no alternative. Because, you know, with rates so low, with some of the other areas in the market that they would turn to, you know, venture capital, property, REITs, et cetera, not looking very attractive at all. And, you know, in my view, the likelihood, and this is probably going to be a bit extreme, of negative interest rates for both the United States and for the United Kingdom, you know, there is no alternative. TINA has become a buzzword in the US. Now, we don't exactly believe that. And I'm going to hand over to Stephanie now, who can pick up the baton and prove that TINA is not the only thing in town. Stephanie.
Thank you, Lester. Before I get onto the topic of alternatives, I just want to talk a bit about the behaviour of asset classes this year, particularly in the month of March, where we saw this breakdown in correlations, which is, it's not new. It actually began last year, pretty much the whole of 2019. I mean, asset classes across the board were making money, and investors, I guess it wasn't such a problem then, because investors are making money in pretty much all asset classes. But this year, I think the events of this year have highlighted the danger when that breakdown in correlations happens. So you can see this chart. I've put a couple of the main corporate bond indices. You've got the US at the top, sterling, and then the two main UK and US equity indices. So this was 2008, just to contrast. You can see as equities fell, you really did get that diversification benefit from owning US corporates. And this is the traditional relationship which we expect, and which most portfolios are built around this relationship. As equities fall, bonds rise, and vice versa. However, as we saw in March, it was slightly different and quite an unusual scenario where, in fact, all asset classes fell simultaneously. So this kind of negated that diversification benefit, which we do expect from having that traditional portfolio mix of equity and fixed income. And this wasn't just the case for corporates. We also saw, which slightly more significantly, a similar situation in government debt. So this is a chart again for March, and we see a massive spike up in the yields of UK and US government debt. And this is representative of investors selling at this period in time. And these are typically assets considered as safe havens. So we saw a similar situation with gold and the Japanese yen. This was a phrase that was coined the dash for cash, because investors are just selling anything they could at this time in preference for cash. So I think what this has really highlighted to us is if we just rely on that traditional equity fixed income mix, it might not necessarily provide that diversification which we need in these periods of market stress. So what I want to touch upon a little bit is the alternative sector and what we've been investing in our portfolios, and which has really helped to protect capital for our clients this year. So to begin with, we've been invested in precious metals for some time now, even before this year. And specifically gold, we've been investing in physical gold as well as gold miners. And this has really helped to deliver some impressive returns this year, despite that small wobble we saw in March when investors were selling. So our iShares Gold physical gold ETF has actually delivered 12% 0.2% for the first quarter, when most asset classes were actually delivering negative returns. Perhaps spoken about a little bit less is silver. And this is something that we began investing in this year, also alongside gold. It shares those safe haven qualities such as inflation protection and that true diversification of holding this commodity. But as you can see from this chart, you've had a massive divergence in the gold and silver price this year. This chart shows from 1950, there's never been such a wide difference between the gold and silver price. We think that obviously this has been down to the coronavirus this year. Silver, almost half of the silver demand comes from the industrial sector, which obviously such as the car industry, which has been hit by the coronavirus this year, which is why we think that the price has fallen so significantly, but we don't believe that this is justified. And as you can see, if I focus in slightly more on the 2008 period, similar situation, albeit not as wide, the divergence between the gold and silver price. But after that period of time, you can see this sharp rally in the silver price after 2008. It rose, in fact, 440% to a peak of 48.44 a troy ounce. So we believe that this is very much possible today, and this is where we see an investment opportunity. And particularly so because silver is used in many clean energy technologies and various sort of growing trends that we see today, such as solar panels that are being used more, 5G infrastructure. So we see the demand for these areas definitely growing, and silver is a main component of many of these. So that's another reason why we think that there's definitely possibility for that price to converge. So we've been investing in silver since around March this year in the main portfolios, and we have been adding to it recently as well, which has benefited us. Another alternative which we've been using in the portfolio for some time now is multi-asset funds. So we see these as the one-stop shop to provide this great level of diversification across a range of asset classes, from equities to corporates to government debt, and then a range of alternatives such as infrastructure and commodities. But the main reason why we really like multi-asset funds is these slightly more sophisticated strategies that they implement, which I've listed here, such as currency hedging and duration management, which we believe has really helped these multi-asset funds to protect capital in this market sell-off this year. And also the dynamic nature of these funds really helps in terms of their ability to adapt to different market environments, and their specialists within each of these areas are able to really add value through their research. So a couple of the multi-asset funds that we've invested in are on this chart here, and you can see, so we have the 91 Diversified Income Fund, which was previously Investec, and then the BNY Mellon Global Real Return Fund, which we've had in the portfolio for some time now, and you can see that they've lost significantly less than our equity index benchmark there. And we believe that these two funds complement each other quite well in our portfolios, because you have the 91 fund, which is slightly more conservative in its risk-taking, so it targets bond-like volatility, while the BMY fund is slightly more punchy, and together they've really helped to protect capital in terms of our alternatives allocation. But what I really want to highlight is how selectivity is really key in the alternative sector. So it's such a wide and diverse universe, and I think, as you would have seen this year, not all of your alternative allocation would have delivered you this capital protection and diversification benefit, which we've seen from some of the ones that we've been investing in. So a couple of examples, we've seen that property funds have once again gated. We saw this happen back in 2016 with the Brexit referendum, and it happened again this year. And I guess it highlights the danger of investing in illiquid assets in market sell-offs. And I guess it's a fundamental flaw with using open-ended products to invest in such illiquid assets. So for us at TAM, we have avoided investing in in property funds since 2016, and that has obviously been beneficial to us this year. We've also seen many hedge funds close this year, as well as many absolute return funds, which claim to deliver positive returns in all market environments. lose in the region of 20 to 30% this year as well. So I think with such a broad and diverse alternative sector, we think the best way to get exposure is to have a diversified bucket of them, and having a dedicated team such as us at TAM who can research such a wide universe and really try and find the most attractive opportunities that are out there. And as Lester alluded to earlier, we don't believe that this volatility is over. We think that it can very much continue into next year and even further. So we think that it really highlights that this alternative allocation is becoming more important than ever now. So just the final word from Warren Buffett: only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. So I think this statement is quite self-explanatory, but it is a philosophy that we have been adopting at TAM since the beginning. We will always seek to own diversified portfolios of quality investments that we believe can hold up through the entire market cycle. So thank you for listening, and I think Joe will be taking your questions now.
Brilliant. Thank you very much, Stephanie and Lester. Guys, it's worth noting that the votes are still open. If you would like to vote on future content for these webinars, I've had really good engagement from you guys on it so far, so thank you very much for that. But for those who haven't yet, it is still open. We had quite a few questions sent over as well. They're still open too. We've got some dedicated time now that we can go through these. Worth mentioning as well, if any aren't answered today live, we do always get back to you on email. Okay, so don't worry, your questions will be answered by us. But the first one, well, there is one on there. Some chap did ask if the sound was lost on our end. I don't think it was. I think that would be actually on your computer. Technology can't be trusted too much at the moment, unfortunately. But the first question for you guys is, should we be planning for a future of inflation or deflation at the moment?
Okay, that's Lester here. I think that's a really very good question. I think what we're seeing at the moment is there's slight fears that with low interest rates and everything else, that deflation is a possibility. But I think what we're building up is actually the inflationary issues, because I think the cost of doing business and the cost of goods and the cost of us continuing to come out of this COVID-19 environment and the limited opportunities that we have to do normal business, it's a balancing act at the moment. I would say in 18 months, we'll be looking at inflation or an element of inflation, although I don't see that coming through in the next 3 to 6 months or becoming a concern. It may if one or two things happen, but I think generally at the moment we're in this sort of twilight zone before we hit I call it the other side of the eye wall. And I think after we come out of that, then I think you could see inflation picking up, because, governments are going to want to refinance and et cetera, et cetera. So there could be an element of inflation creeping in, I think, but I think it's kicked down the road slightly.
Brilliant. Thank you, Lester. Second question that we've got here is, can you clarify TAM's short to medium term strategy and how the investment philosophy has positioned the company over the past 3 months?
James Penny, our UK CIO, is on this call as well. It might be more appropriate. I mean, I'm happy to answer it, but James, you may want to say a few words about what we've done the last 3 months and where we're looking to be for the next 3 to 6 months.
Yeah, I think thanks, Lester. Thanks, everyone, for joining. Just with regards to our investment philosophy over the short term, over the long term, obviously capital preservation and defence of assets remains critical in the short term. Long term, obviously, you will have heard this from many people. There are a massive amount of opportunities on offer, and we absolutely want to capture those. So that speaks to the long-term intentions. But over the short term, 3-6 months, as Lester alluded to, we have to get through this earnings hurdle, which is going to come out the back end of Q2. We need to see what company earnings are going to be like, and more importantly, we need to see how the stock market reacts to that. There's been a lot of interest, in buying just because the Fed are there. So we need to see if that confidence in stock markets remains as strong when we see the economic effects of COVID. And until that happens, our investment philosophy is going to very much remain around defense. It's going to very much remain around high quality assets, companies that are going to be survivors of this environment. And as we continue to move through into 6 months, 8 months, we're very much going to be led by what the market does. We're very much going to be led by how these earnings are, what the earnings projections are. Is the recovery better, worse, in line with where we think it's going to be? So, it remains steady for now, and high quality assets remain king. Cash is king, gold's king, alternatives look really good. And if the environment is a little bit more buoyant than we're currently pricing in, then we'll start to increase the allocation to quality. But what we're looking at here is super high quality stocks. And that's going to remain the theme for the next 3 years, 4 years, companies with very, very high barriers.
I think if I could jump in just a second, we do have very high levels of cash, but as I try to allude to in one of the slides, the market is very narrow. There are some very, very strong gainers in certain sectors of market and some very weak areas. So actually being diversified and fully exposed to the financial market is really not helping. You need to be in some of those things that are really sort of COVID plus beneficiaries. So we have, where at the beginning of the year, I think, James, we were more recovery oriented. We very quickly changed that stance and went back to what I would call the strong growth and high debt, low debt, high cash balance sheet company investment managers. And so there has been a shift, and that has meant that even though we're underweight equities by quite some margin, we've kept up with the rally. We've actually not lost out on the rally, even though we're underweight, because you can actually be slightly more selective. This is one of those situations where a tide's not floating all boats.
Brilliant. Thank you very much. A nice surprise cameo from our CIO, James Penny there. Thank you very much, James Lester. Next question we have here is with regards to particular industries and sectors not being attractive at present, are there certain places that TAM is seeing as more resilient or places to pick up unforeseen opportunities from?
Yeah, look, there's going to be a lot of opportunities out of this. The trouble is, it's gone past the sector bit to a degree, because, let's take the worst of this, which is the entertainment industry or the travel industry or whatever. There are going to be big winners and big losers coming out the other end. If they can get through this, what will be coming out of this will probably be, like industry winners. I mean, they're going to struggle, but there will be industry winners. So there are, I think we've gone beyond what I call the sector call. The sector call is strong balance sheet, e-commerce, it's the internet-based operations. That's what's winning at the moment, and it will continue to win aggressively. But beyond that, when you start to get into the sectors that have been bashed the most, there will be winners and losers. So for us, it's selection, not industry sector that's the most valuable to us. There will be some very big losers. They'll go bust. So what you don't want to. You could have two companies that look fairly similar, and one will survive and one won't, because it will do something during this that will not really help it. So it's going to be a very it's a stock picker's market. It for sure is. It's not going to be, let's just buy retail. That'll all come out of it. No, for sure not.
Brilliant. This next question does dovetail quite nicely off of the last one, and is in relation to our previous slide, the quote from Warren Buffett. Is there a company or sector that you would be happy to hold for 10 years at the present?
I've got some ideas, but James, I'm sure you've got yours as well. Go on, you have your say on this one.
Thanks a lot, Lester. It's a really great question, given how fractured markets are. And I just want to go back to Lester's sentiments in that, you can't call a sector right now. You can't just say, oh, that sector's good to be in, that's bad to be in. There's going to be a huge amount of winners and losers. The market's going to be a lot more fractured, which makes active management key. In that, I would actually say that, my chosen investment for the next 10 years would be a global fund. It would not be a specific stock or a specific sector. It would be a manager who can understand the fractured nature of the market and pick out the diamonds from the rough for the next 10 years. I really think that, that type of investment, that style of investment is going to come to the fore. So sorry to dodge round your question a little bit, but I think the diversification of a collective fund or a DFM's multi-manager portfolio, I really do believe is the place to be.
Okay, brilliant. Thank you, James. Guys, I think that we can leave it there for today. We've had some really, really good engagement from you guys, especially in the votes. So this does really help us in planning our future webinars, and I can see that there are some obvious front runners in the topic for the next time. So we do want to make sure that these are as tailored as possible to you, and make sure that you get the most out of them as you possibly can. Please remember to leave us any feedback. Again, very much appreciated. And don't forget that you can find a copy of today's slides under the Attachments tab. You should receive a CPD certificate emailed over from BrightTalk. If you don't, please feel free to contact your TAM Business Development Manager and he'll be happy to assist you with that. But apart from that, thank you, James, thank you, Stephanie, and thank you, Lester, for your help today. And thank all of you guys for dialing in as well. We really
thank you. Have a very good day.
Thank you.